Well, strong earnings and productivity, market breadth, and a healthy U.S. consumer are all reasons cited by our next guest for his bullish view on U.S. stocks, even if February ends up being a bit of a choppy month. For more on how he would translate this outlook into an investing strategy, joining us now from Cincinnati, Ohio, is Ryan Detrick, Chief Market Strategist at Carson Group. And as you can see, he's on our screen now. Ryan, it's good to be with you again. Thanks for making some time for us. It has been a bit of a choppy month in February thus far. What is your view of the macro picture that investors are dealing with right now?
Yeah, Paul, thank you for having me back, and happy Wednesday, everybody. So you think about it, I mean, at least from a U.S. market's point of view, we just hit an all-time high on the S&P yesterday, and it felt like one of the least exciting all-time highs we've seen. Working with financial advisors every day like I get to do, hearing from their clients, right? We know, right? The worries are there. Tariffs, trade, the Fed, AI, DeepSeek. I mean, we've been hit with worry after worry so far this year. Yet you look up, and again, S&P's up well over 4% for the year, hitting new highs. Let's just talk specifically about February, and then we can go on here. The first half of February is usually pretty strong, Paul. It's the second half that's kind of that banana peel. It doesn't mean it has to happen, trust me. But after the run we've had, maybe we're due for a little bit of break, a little bit of consolidation. One final thing for the listeners, the month of February, when you look at a post-election year where we are right now, is usually the worst month on average. Again, that's just averages. I get it. But we're still bullish, yes. But maybe a little consolidation would be perfectly normal here. But like you listed some of those things, why we're bullish and why we still are. Honestly, we've been coming on you for a long time. Say we're in a bull market. We're still in a bull market. That's the good news.
How much stock do you put in those that kind of historical data, such as February being one of the weakest months of the year? Now, the sample size is pretty large. This graph is going all the way back to 1950. That's before I was born, so that's a long, long time ago. How much credence do you put in this type of data?
Yeah, I mean, a decent amount, right? I mean, it goes into the pie, right? All different things. I mean, let's talk about one earnings season, right? What do we focus on also? Well, we know the seasonality and the market trends. You know, two things I'll talk about. Broadening out. You mentioned that. There's 11 sectors in the S&P 500. All 11 are up on the year. As of last Friday, the end of last week, 7 out of the 11 were outperforming the S&P 500. It's not about 7 stocks anymore. Yeah, maybe 2023, parts of 2024, the Mag 7, we get it. But now we're seeing broadening out for investors out there. That should be music to your ears, where a well-diversified portfolio should really start to do quite well. Then the other thing, earnings season is wrapping up here in the U.S. We've got some retailers this week, which kind of means you're at the end of earnings season. Overall, earnings have come in much better than expected. Once again, that's usually how it works. But here's what really got my attention. Profit margins on 8 out of 11 sectors are higher during this earnings season. So profit margins are hitting new cycle highs. Earnings hitting all-time highs. Revenues are solid. Those are those backstops that, again, surprises happen in a bull market to the upside. When we hear things like that, we would say that's probably why we're hitting new highs with all the scary headlines that we keep hearing about.
This is a post-election year. We're in 2025. There was an election in 2024. You've also got some historical data on that, where post-election years tend to be good years for stocks. And here's a graph. We're looking at post-election years. The white line is the past 10 cycles since 1985. The blue bars, they're not lines, they're bars. The blue bars are cycles since 1950. So you still see positive performance, a little less so since 85. There you see a midterm year. That's the year when the midterm election's coming. That will be 2026, the next time that rolls around. A pre-election year, so that would have been 2023 most recently. And the election year itself, that would have been 2024, as you can see. And the strongest gains of those 4 classifications seem to be in post-election years.
Well, put it this way. The last 10 cycles, that's back to 1985, 9 of the last 10 post-election years, where we are right now, have been higher for the stock market here in the United States, right? If you go back to 1950, it's not quite as strong. So something's happening, you know, in the last 30, 40 years or so. What is it? I mean, I think it's maybe because you mentioned midterms. Midterms are a big deal. Most people probably know the pre-election years usually pretty darn strong. 2023 was a perfect example of that, where you kind of get the economy going, you get the stock market up to get people feeling good. But midterm years are such a big deal anymore. We've seen those post-election years do better lately, again, probably ahead of midterm years years. These are just little nuggets. These are just little things you would not want to blindly invest in this. But when I point out, or we point out, 9 of the last 10 post-election years were higher, Paul, that's something I want to pay attention to. We talk about a market that's broadening out. Pay attention to that. One more thing, market sentiment, even though we're hitting all-time highs, like nobody seems to care, which is kind of fascinating to me. And it's music to my ears, that contrarian indicator, the AAII sentiment poll. I'm sure you've talked about this with some of your guests. The most bears we've seen in the United States since November of 23. Look at inflow, outflows, 2 weeks in a row, outflows from U.S. equity and U.S. ETFs. I mean, no one seems to be believing this is still a bull market. They see the headlines, and the headline risk is real. At the same time, what's real is this is still a bull market, and it's hitting highs. One more thing you probably mentioned is 5 years ago today was the peak for the S&P 500 before COVID. 34% bear market in 5 weeks. Had you invested on that day, that day, right now you'd be up 81%, up 12% annualized with a 100-year pandemic in there and a 25% bear market back in 22. That's amazing. But for longer-term investors, listen, when it gets scary, we understand your nerves work, and that's how it goes. Just remember that next time you see that, the two terrible bear markets, we're still up a lot the last 5 years.
Okay, I have not left enough time for you to talk about your strategy,
right.
But you do like small and mid-cap stocks. Give us 60 seconds on why you like the small and mid-caps.
Yeah, I got a little wordy on that last answer. Sorry, Paul. Listen, we think the broadening out theme is real, right? We don't see a recession in the United States. We see things that are really cheap, small, mid-caps, financials, industrials, your cyclicals. Those are areas that are underloved, underappreciated. Maybe financials a little appreciated now because they've been doing well. But we think those areas are going to start to really do well. The lifeblood of a bull market. Passing the baton around, rotation. We think that rotation is real, and tech has lagged. Tech has lagged for a while. Doesn't mean we don't like it. We're more even weight tech, but to see other groups taking the baton, wonderful thing for investors out there.
Ryan Detrick, thanks as always for your insight. He is Chief Market Strategist.